So hi everyone. So 2024 has already started actually with a bang. We have seen the markets have run up almost 2000 points now in the last couple of months now almost. And this is a very sharp move. But we also need to understand that we have spent almost 2 years, hovering around 17,000 levels. And now it is very interesting, because we have events also in 2024. We have our own elections. Then we have the US election in the month of November. And also there may be, an event type of interest rate cut from the US Fed, which will be looked after by all the emerging markets. And also the positioning of the crude oil prices when we look at the geopolitical crisis which is happening in the market currently near the Red Sea and all. So those questions are there, events are there, and let us see how the market is going to evolve now as per our understanding. What are the major macros that we are looking at? What are the major sectors that we are looking at? What are the trigger points for India to perform even at these levels? Let us understand as per our thought process. We are from ICICI Securities Portfolio Management Services, and we are managing close to 2,500 crores now, the public money. So when we look at the dollar index, so dollar index has not been able to move higher despite in the month of February 2023, we had 4 or 5 banks collapse, the regional banks collapse. That time also, it did not go to the highs of 2022 that we saw actually when the Ukraine war started. So in February 2023, it was somewhere around 105. And recently also, when there was a war of Hamas and all, it remained lower. So that means the dollar index actually broadly has remained subdued despite these geopolitical crises. And that means it's a good scenario for emerging markets, because when dollar remains weak, we have seen that the foreign flows starts coming into the emerging markets, and India, which is growing with a decent 6-7% of growth, they are likely to see the continuance of this. In fact, 2023, we saw within 6 months, almost 1.7 lakh crore of flows came into the Indian markets. Generally, within 2 years of scenarios, 1 or 2 year of scenario, we used to see this much of flows, but it came within 6 months. And this is what you can understand from the liquidity perspective, that whenever it is going to come, it will come actually very, very robust, and that can drive the many various segments of the market. So in the US, slowly now the US indices are nearing the life highs. They are also smelling the going forward interest rate cuts. Their economy was not in a very good shape. There was a question on hard landing or soft landing, but eventually the equity markets, they spent a lot of time and then they came close to the life highs. If you see, Dow Jones Industrial is the first which has broken out. The other two are on the verge of that. In fact, Nasdaq, which had declined more, it is taking a little time to take out the life highs, but Dow Jones Industrial. So industrial has been a buzzword. If you see in India also, because the government is putting a lot of efforts on capex, and industrials are doing good. In US also, we have seen that Dow Jones Industrial has taken the lead. So this particular move looks like this drives the theme, this drives the sentiment for this particular space for the coming years also. When we look at the bond yields, so bond yields which had moved up very sharply in US from 5%, they have topped out and again declined. And if you see Indian bond yield, so you just look at these two circles. In 2022, mid of 2022, the bond yields in US were somewhere around 3.5%, and the bond yields in India was somewhere around 7.6%. After that, Indian bond yields have not taken out these levels. They have remained subdued. So obviously, in this move of the US bond yield, we have also declined. But if you see in US, it has surpassed those levels in 2022 itself, and then in 2023 it made a further new high. So when the bond yields actually are moving higher, sometimes we don't see that the equity markets are performing good. And this is what happened in US, that it took time to come closer to the life highs, but Indian markets already breached the life highs before and they moved much higher. So this is where the outperformance is coming in Indian markets, and I don't see any major deviation of this. Yes, time correction, consolidation may be there because you have already run up 2000 points little faster, and that is where that trajectory of more broad market, more sectors evolving, that continues even if the market remains consolidated. So FPI flows, we talk about FPI flows in equity market, which came in 2023. If you look at the bonds, so in the bonds going forward, because from June onwards, the JP Morgan bond index will add the Indian bonds, you will see almost $23-25 billion of flows coming because of that. And that is where actually the government borrowing in financial year 25 going forward, 12% of that borrowing can be funded with this $25 billion. It's a big thing. It's a turnaround situation actually for the bonds in India. It can bring some volatility, but it will also bring a lot of flows. So it is not only JP Morgan who is going to include. Now Bloomberg also has announced going forward, other indices also will come up and they will also announce. And this is where this is a good scenario for Indian bonds. And when the flows are coming, whether through bonds or whether through equity, it is good for our current account deficit situation, because then it remains more in control, and which is where the currency, it does not depreciate that much. So it is also possible it can appreciate if these flows, they remain equally robust in the equity market segment also. So from the real estate perspective, I still remember in 2003-2007 cycle, which is called as a super capex cycle, we saw the real estate also was performing really good. The same scenario is building up now after a long period of time. In fact, when we look at from 2010 till 2022, it was a less than 2% of sales CAGR, but right now it is almost 10% CAGR. The growth which is expected from 23 to 28. That means in the coming year and the years, it is possible that this housing cycle, which has evolved after almost a lull period of a decade, it can be there for another 4 or 5 years, scenario. And this is where, yes, declines will come, profit booking will come, but we need to identify those stocks, which are really doing good in terms of a balance sheet situation, because that is always a question mark in the real estate. If they are really doing well from sales perspective, if they are really doing well actually from the NPA's perspective, that is very important, because the net asset value calculation, what we do in the real estate, so that is driven actually from the actual assets, what they are having and the liability side. So we have to be little careful. But yes, this growth, this money is definitely moving. There are some new players like Macrotech developers, which were listed actually not too far, recently. And then Prestige Estates, we have seen very good numbers coming from Prestige Estates. So numbers are coming good, and I think this is where. So premium housing is something which is actually coming up. You have seen that the flats, the houses of 40-50 crores, they are being sold now. And this is where the margins actually are coming better for these players, whether it is a DLF or it is Oberoi Realty or it is Prestige Estate. So the margins actually are coming better. And I think going forward, this particular K-shaped recovery in India, which is driving more high-end discretionary expenditure, and that particular segment is actually expanding, which is benefiting these luxury houses being sold. So this is driving the overall positivity, to my sense, in the housing space, and which can continue. We can look at some housing material spaces also, which are in the luxury space or the direct housing. So from the thermal, capex perspective, what has happened, because previously we were talking about renewable energy, but for that also, because renewable energy runs on 40% of capacity utilization, we have seen that the base load thermal is required. The base load power is required, which is thermal. Also in the night, you need an alternative, and this is where thermal again is required. So thermal capex, which was actually very low. It was actually declining from in the last 6-7 years. You look at from 2016 till 2022, it was growing only by a -1% CAGR. Now it is picking up actually. It is picking up by almost 20%. Why? Because the current plant load factor has gone to almost 77. So the plant load factor going to 77 means more capacity utilization now, and this is driving the further capex. And this is where the order book positioning or certain players in the market, you take the case of BHEL, so their order book positioning actually is coming better. And I think the whole reform process which government is coming out with, they are increasing the tariff rates, they are coming out with the smart meters, so lesser slippage in the power. I think this is a good sign for this space. They have been long time underperforming, and they can perform actually now for a longer period of time. So this is the capex which I was talking about. It was almost -1% CAGR, but it is now growing by almost 20% CAGR. If you see now the Nifty P premium over the emerging market, so Nifty P premium actually is somewhere around 67%. And previously we have seen it has gone to 90% also. So from that perspective, we feel there is still room for this premium to grow if only Nifty is going to perform over the emerging markets. Because in this move, we have seen some emerging markets also performing when dollar is weak, money flow is coming into emerging markets. And that is the reason the Nifty premium over EMs is not 90%, rather it is much lower. If you see the Nifty PEG positionings right now, so Nifty PEG is around 1.31 and the US is around 1.64. So the earnings growth actually in India is around 17. The only other market which is showing above India is Taiwan, but there the price to earning is lower, and that is why the PEG is very attractive around 0.9. But actually this is happening because the FIIs are keeping themselves away because of China intervention in Taiwan. So India actually has a better attractive valuations from the PEG perspective when we compare with US. And this is where if somebody says that if interest rates are cut in US, they may have a higher delta or higher move, but India is also equally attractive and it will not stop if that is going to happen. Another important point is the PSU stocks actually have started performing now, right? So when we look at the valuations of PSU index price to earning and we compare with the Nifty price to earning, then in 2012-2014 period, in that cycle, if you see, it used to be at 38% average discount. It actually declined to almost 65%. And now it has come closer to 48%. That means another 32% of upside is possible actually in the PSU index going forward. And this is where you are seeing more stocks coming out now after the long period. We have seen the mining stocks coming out. We have seen the mining equipment players coming out. So there is a segment which was not performing. We have seen that segment is coming out now. And that is what I was saying, that if you are getting something at a better price to earning, but simultaneously you are getting a good earnings growth, and you can get it only in those stocks which are coming out after the long consolidation period. So Nifty valuations are somewhere close to in between 2021. It is little stressed, no doubt about this. And but we have seen actually previously it has gone to 25, 24, 24 and a half also in these stressed situations. This is an event year. So it happens sometimes that we start factoring the positivity of the event before that. So this particular move, if you see 3 times, it has gone closer to 18 times. And then it has seen this move. So our sense is that this market, which has already consolidated, it has started moving up. So this it will throw a lot of opportunities still, stock specific, and that kind of digging we have to do, and the portfolio creation we need to do with those kind of stocks which I am discussing. From our research perspective, Nifty 2024, the target that we are keeping is around 25,000 because we are discounting with financial year 26 EPS. which is around expected to come around 1250. So 20 times is the multiple right now. 20 times multiple we are keeping with respect to financial year 26. And that is where these kind of targets are coming, because Nifty EPS has been growing in double digit, no doubt. So crude is lower. It is expected to remain around 14-15%. And that is where, if you look at 2024, it is likely to close at 960 or 980 rupees of EPS. 2025, it is likely to be around 1100 rupees of EPS. So 15% of close to 15% growth. Financially at 26, it may be around 1250 as per the expectation. Because of the higher base, now it is around 14% around. So this is where the double digit Nifty growth continues, and with crude being lower, you can expect the sustainability also of this. And crude, if you observe, the Venezuela is open now. Yes, Venezuela, the whole capacity is not open, but yes, previously we were talking about Iran before, but actually it is open now. Venezuela is open. So that will keep the crude prices lower. Yes, supply cuts, disruptions in the Red Sea, attack by the Houthis, and Middle East situation, it will create some kind of pullback to the crude, but more supply scenario from US, because elections are there. They can also try to keep the crude prices lower, and also from the Venezuela perspective, our sense is this extra supply will keep the prices subdued, which is good for India perspective. If you see the 2024 earnings revisions, we have seen Indian earnings actually have grown. Actually, the others actually have degrown. So this is a situation that China still is struggling. In China, we have seen that the shadow banking, which gets lending from the bigger banks, so they have reduced that lending actually to the shadow banks. So this is where the Chinese markets also are struggling. The economy is not able to get that kind of growth. But when we look from the consumption perspective, so China also is seeing the K-shaped recovery, because there also we have seen that the high-end discretionary is picking up what is happening in India also. So for example, when you look at the Tata Motors numbers, the Jaguar, which has 8% exposure to China, they are doing good. In Europe also, when you look at from the consumption perspective, the high-end discretionary is actually better placed. So this is the scenario across post-pandemic, that the lower the segments, they are still struggling. And that is where the mass consumption is not able to come up. When we look at the stock prices also, they have not been able to performing, which are related to that. So when I look at the capex, so still, if you compare the capex with 2003, 2007, it is still lower than that. 35% we had achieved in that period, and now it is 30% of GDP. So this is a good room. It is picking up, but there is a good room now for this capex to climb further higher, and it is likely to be supported from the private capex. So listed corporates, they have done almost 8.1 trillion rupees of capex in the last 12 months. Otherwise, earlier, the major capex was driven from households in the real estate or the central government capex. But now the listed corporate capex, in fact, the state capex also we have seen of 7.1 trillion rupees in the last 12 months. So those spaces are coming up which were lagging actually in the capex cycle. And this is where, if you look at the capex, which starts with a higher capacity utilization, we have already seen it is reaching 80% actually right now. And that is the reason the private capex is picking up. That is the reason the PSU banks, which can start performing, where NPAs are lower, where the lending book is growing now. In the corporate side, it is only 6% lending book growing. Otherwise, if you look at the average growth, it is 17%, but that is more unsecured lending and all. In the retail space, where RBI has already raised the red flag, but the corporate book is growing by 6%, and which is good actually. With more private capex, you will see more move in the PSU banks going forward. So current capex cycle, this is what I was talking about. When you compare with the period here, it was somewhere around 10, 12 trillion rupees of the capex. Now it has gone to almost 26 trillion rupees of capex. So from the state and center, and along with this, the listed corporates. So you can see this figure is somewhere around 26 now, which is coming in financial year 24. When we look from the capital goods order book perspective, so it was growing by around 7%, now it is growing by 28%. So there is a good move in the major capital goods numbers in the order book positions perspective. So this is happening because there is more demand coming from various segments like mining, railways, defense, and this is where the capital goods and power, and this is where the capital goods actually is looking quite strong from the order book positioning. When we look at from the vote on account perspective in the coming budget, we have seen that previously also from 2009 onwards that the something related to farmers is announced. So whether it is the farm loan waiver, whether it is the Food Security Act, whether it is, in the BJP time also we saw some basic income scheme came up, the MSP prices rose. So we don't know what is going to be announced this time. It may not be nothing. But yes, this drives some sort of move in the rural space. So two-wheeler numbers we have already seen now, they have recovered. So two-wheelers are doing good currently. And yes, they are still 15% below the financial year 19 numbers. But yes, I think towards elections, towards this vote on account, we can see some more move in the consumer farming space because of some kind of announcement which market can expect. The fiscal deficit numbers are still around 4.5%, going to be in financial year 26. This is what the commentary was before, and we believe this commentary is on path. And this is a good, fiscal awareness or fiscal consolidation the government is doing. It moved to very high in financial year 21, and now whatever they are doing. So government borrowing is not increasing much, despite so much of capex. Because they are able to garner good GSTs. They are able to, get the crude at a discount from Russia before. Yes, I understand the discount is reduced than what it was before, but yes, they were able to save a lot of money because of that. So the government balance sheet is much better when we look into 2024. The PAT to GDP, if you look at, and compare with 2007, it was 7.4%. Currently, it is around 4.9%. We expect going forward, it is likely to move towards 7%. So the GDP is growing, but on the GDP, the profitability of the listed corporate is also growing. So this will surpass the GDP growth, and this is going to drive the equity markets and the stock specifics. And that is where actually we see a good trajectory going forward. Market cap to GDP also, if you see in 2007, we saw it was almost 156%. It has not reached there. It is still lower, around 100%. So this is where I think there is a room for some more premium coming into the market cap. So one way is more companies can come out with an IPOs, right? And this is the trajectory we are already seeing for the last now few months. And going forward also, I think more IPOs will come. That will also expand the market cap. Stock prices which were not performing for a long period, 10, 15 years, they are also coming out now. And those stocks prices can also expand. And that is also lead to more market cap to GDP. So there is a room here. The same room what we saw in Nifty price to earning over the emerging markets, the Nifty premium over the emerging markets, there was a room over there. The same room is here in the market cap to GDP. If you remember the INR in 2003-2007 cycle, it had appreciated. So that appreciation cycle is not seen yet, right? So we can expect that INR depreciation can halt because the dollar index is also looking weaker. It is also under pressure. And if more flows come in bond and equity markets in India, you will see that some kind of appreciation in the INR also can be seen. This is a real estate cycle, growth. Previously, we have seen that the wages of lower the pyramid people, the carpenters, mason, actually that wage growth is seen, which drives ultimately the mass consumption. And you can see here, when the real estate investment happened in that particular cycle of 2003, 2007, we saw that the real estate actually was investments were increasing from the households, which happened actually in this cycle also, and that drove the wages of the carpenters and masons. So this is what is going to pick up. This is what we believe going forward. People also have lost jobs, so those unskilled people can get jobs because of this infra move or the house building move. And I think this is where this if this wage growth increases, you can expect the mass consumption or consumer goods, those kind of products can also start performing, which have not performed actually so far. So this is the GST numbers now. You can see here, it has been consistently coming above 1.6 lakh crore mostly now. So there is a good base which is now built up actually for the GST flows in India, around 1.6 lakh crore. And our sense is, once this base is made, now it will likely to go to a different base now. So eventually you will see this number is moving towards 1.8 or 1.75 lakh crores also. We are waiting for that. That will bring more flows. In fact, the direct tax numbers are also growing. The kind of compliance the government has put in actually in the direct tax, we have seen that those numbers also are equally growing. So and you have seen the rate actually from IT in on the some corporates. So yes, what happened with Polycab recently? So it shakes up the stock price, it shakes up the system, the sector, but eventually we see that that the whole system actually gets better when such kind of things happen, and this is where more flows in the tax number, whether from GST or direct tax, it keeps on coming. So yes, the government is very tight on the compliance, and that is, you can see actually now in the numbers. It's very interesting that SUV, which was 50% of the overall passenger. If you see the Apollo tire, which has more than 31% market share in the commercial vehicle space, and which has increased the market share in Europe by almost 270 bips in the previous period. In such a saturated market, those players actually can perform better, particularly when the crude prices actually are trending lower. So this is the benefit which goes to the tire companies. Government is also focusing on mining in India, right? So our research perspective is that these are the initial enablers, whether it is iron ore, which is used in steel, you have a 300 ton of steel requirement, or it is power which comes from coal, thermal power. So that is also increasing. So coal India, has done the incremental, one of the highest coal extraction in the last year. And NMDC also, if you see, the core iron ore sales volumes are going to increase. So this is the reason these companies can start performing even in 2024. And the valuations are attractive because Coal India is available around 6-7 times and NMDC around 9-10 times. So they are available at better valuations. And this is what I said, the companies which are coming out for a long consolidation have a better price to earning, and the future outlook for earnings growth looks much commanding. Those stocks can definitely participate going forward. So these are all our emerging sectors. Defense is another space which has performed, no doubt about this. But the government focus on exports, it was 13,000 crore, it reached to 16,000. Now they are talking about 35,000. Already the order book positioning is getting better. We have seen the market cap expansion in Hindustan Aeronautics and Bharat Electronics. We believe the companies like BEML, which has become part of our portfolio, and the order book is likely to move towards 17,000 crore now. So that 70% jump is very much possible even in the market cap expansion. And these kind of stories are coming up. So if you look at BEML, it caters to mining, It caters to railways, metros. It caters to defense and aerospace. So if you look at, they have got order now from Patna Metro, Mumbai Metro, Chennai Metro, Bangalore Metro. Order book is increasing. They are actually, provide mining equipments also. So as I said, the mining activity is increasing. So even the mining equipment, manufacturers, they are going to be benefited. Electronics manufacturing in India, the export, if you see, has reached to almost $25 billion. If you look at China, it is $900 billion, which is much, much higher. So Indian exports are picking up, but there is a lot of room for more production of electronics. If you see the whole electronics manufacturing market, it is $2.9 trillion market. And the EMS is $900 billion market, where India had a market share of 2%, and they are looking actually to move towards 7%. So a lot of things. And going forward, actually, whether you talk about electric vehicles, you talk about the 5G applications used, you talk about the clean energy, or you speak about artificial intelligence, virtual, augmented reality, Internet of Things, you will see that the use of electronics manufacturing is increasing now, semiconductors going forward. So this is where it's a buzzing thing. And I think it is, you will see the companies which are scaling up much bigger, they are going to be benefited. So this is the electronics market. It is likely to grow from 25% to 40% when I talk about the export. So out of the total production of $102 billion, $25 billion is being exported. Out of 300 going forward in financial year 26, this is the projection. It can become triple the total manufacturing of electronics goods. So the export also will move from 24 to $120 billion, which will be almost 40% actually of the overall production. When I talk about decarbonization, so obviously the focus on renewable energy, green hydrogen, ethanol. So ethanol thing is still on. And I think the government has reverted actually the previous decision on the sugar companies. And eventually, because this is a focus area, the government is actually talking about on hydrogen on the fuel stations now. They are going forward. They are talking about the blended ethanol. They are talking about the electric vehicle chargers on the fuel stations. So they are all going to happen. So electric chargers expansion we are already seeing now, and this is where the growth in the electric vehicles, which has already grown from 5% to 6%, and this particular year, and the total renewable capacity taking from 175 to 500 gigawatt, that is the next thing. So we believe there is a lot of room here, and the companies which are in this segment, they can do better going forward. Yes, we need to be aware of the valuations, because sometimes the things are factored very fast. But yes, it is also there. If earnings growth continues and at a certain valuation, at a certain time period, you find the valuations attractive. If you see, out of the total around 86 airports in India, we have seen that they have started using the green energy. So almost 55% of these, they have started using 100% of renewable energy so far. It's a very positive thought that the airports, they are using the renewable energy resource also. Infrastructure railways. So you have seen in financial year 22, it was 3.74 lakh crore of expenditure. It increased to 7 in financial year 24. They further upfronted the infra spending because the elections were there going forward. So India is about to spend 143 trillion rupees now going forward in the coming years. So this is a big amount. And they recently around 27 new highways they have opened up. So the construction companies were not performing. I think when the crude prices are lower and there are more highway projects which are opening up, you will find some road companies also performing going forward. So from the bank's perspective, NPAs actually have come lower continuously, and the average credit growth has increased. So the only point is, which I want to highlight here, is the corporate lending book, which is likely to grow now from 6% to higher because of the recent private capex which has picked up. So this is likely to lead to more corporate linked banks performing better in the coming months. So there are many sectors like hotels, housing, paper, healthcare, SUVs in automobile, jewelry. So most of them were not participating actually in the last decade, and this is a new money which is moving here. So jewelry, I understand it was participating before, but jewelry, because of the gold prices, the people are using it as an investment. The marriages actually are on record high, so that is driving the jewelry sector. Hotels, if you see, we have seen that the average room rate is increasing almost 15-17%, and the occupancy rate from 60% has increased. So hotels actually, which were not performing for the last 13-14 years, they have come back. So there was a good move before, but when the COVID situation came up recently, we saw more cases coming up in COVID. I think when it is not impacting that much, people are getting cough and cold and getting absorbed. The hotels again have started performing off late. So as I discussed before, lemon tree is one of our top picks in this particular space. Housing, yes, the premium housing is doing better. Paper, I think it will come back post elections. Unorganized to organized beneficiary clearly is healthcare. In fact, in healthcare, if you see the EBITDA, the EVY EBITDA was almost 18 times. When the Manipal deal happened, it happened at 24 times. So afterwards, you saw that more hospitals IPOs started coming out. So this is going to happen whenever the valuations go higher. More IPOs in that segment will come up. That is something that you need to be watchful of. So as SUVs, I discussed, it is almost 50%. In fact, more than 50%. As I said, 63% going to be of the total passenger vehicles. So we have this portfolio PMS, which is ACE equity portfolio, ACE equity PMS. These are the some statistics of ACE equity. Why I'm talking about ACE when I am talking about the outlook for 2024, because I believe you also need an investment vehicle for your money, right? And that investment vehicle from ISEC is ACE equity. So if you see, our primary objective is to keep the price to earning lower. You can see here the price to earning is much lower than the index, and the earnings growth higher. So earnings growth of this portfolio is much higher than the index. So these two are the main primary impetus that we are looking to find out the stocks in this portfolio. So the price to book, price to sales also are very, very, very relatively lower. Beta actually 0.9 standard deviation is almost equal to Nifty or little lower. So this is a very good proposition actually for such portfolios. And we have kept large cap 50%, 40% mid cap, and 10% small cap currently here. So this is the performance for the last almost 3 years now. You can see that it is compounding by around 20%. In fact, now more than 20%. In the last 3 years, which is a very good compounding. In the last year till date, from April onwards in financial year 24, there is an outperformance of more than 10% in this. So this is a very good product, very good portfolio, which outperformed many peers even in 2021, 2022, and even now it is outperforming some of the peers plus the benchmark. So it's a very stable all-weather portfolio which has a lower PE and high earnings growth, and this is what you need to look at right now in the markets. So some examples of this portfolio, as I discussed before, lemon tree. So lemon tree average, the gross trend, if you see for the average room rates, it is the uptrend. There is some debt in the books, no doubt. The debt to equity is somewhere around 1.9, 1,600 crore of debt is there, 10,000 crore market cap. We believe that this debt will be paid off if they are going to increase the tariff rates now, which they are talking about, and it is actually happening. So if you compare the revenue CAGR of Lemon Tree in comparison to other hotels, it is actually higher. Even the EBITDA profile is also higher than others. So that is why this is a high growth trajectory in the mid-size hotel segment where you don't find many names listed in the market. BML is also part of our portfolio, as I discussed. This is catering to many high growth segments. And this is a company now which is linked to defense, metros, railways, and the order book positioning in all of these segments you can see here, is building up. And this is where, and this is also the divestment candidate actually from the government. Previously, the government came out, and I think post-election it is possible, which can re-rate the stock further, and 52% of government holding, I think, going forward. So this is the bifurcation of the order book. Financial year 23, you can see the order book here, and this is the bifurcation. So mining has remained 43-50%. Railways, is picking up now. So, they have got orders from a lot of metros players. So 41%. Defense is around 16% of the order book. So yes, it is catering to the segments where the government focus is there, and that's why this company is really doing good. So that's all from our side now for the market outlook, the stocks, the sectors, what we are looking at actually from the inherent growth perspective from the markets. So I am getting some questions now. So let me take some questions. The one query, is on the FIIs. So do you think that the FIIs which are waiting actually outside, so that flows can come? So if you see, our research had recently came out with a report that the FPI holding in Indian markets, which used to be around 20%, it declined to 16.5%. So there is a room, no doubt, about FII holding to grow actually in the Indian markets. And as I said, the dollar index positioning is lower. Crude prices, if it remains stable and lower, then I think you will see that going forward more flows from FII. Not only equity, it is also going to happen actually in the debt space. So there is one query actually on the banks that how do you see banking sector performing? Because last 1 year, 1.5 years, we have not seen the banks actually performing that much. So we need to understand that when interest rates were rising, the NIM of the banks expanded because it is a lending book, it is a lending rate which they increase first. And now when the interest rate cut scenario is going to happen, they are factoring actually that NIM shrinking is going to happen. So that has already started factoring in the banks. We have not seen major performance over there. In fact, the performance has come in some of the NBFCs which are catering to power and railways. So we have clearly seen in those spaces the money flow has come and it is driving because those stocks were not performing for the last 15 years. But I think the banks can perform now, even now, because the lending book is growing, the corporate lending book is growing. So corporate linked banks, to our mind, can perform actually better. So there is a query actually on the technology space. The people want to know how the IT sector is going to shape up. You don't find IT names in many portfolios currently. They were underperforming, and suddenly the market started thinking that the bottom is made. If the growth is not coming, at least the bottom is made, and that is driving actually the IT stocks. To our mind, we believe the valuations actually have come up. Financial year 25, the next year, the mid-cap IT can still be looked at. So this is very critical because we feel the large-cap IT actually has come under pressure because of the regional banks collapse in India, in US. And that is continuously putting pressure because they have postponed the orders. So this pullback is fine, but the growth, the guidance still is missing. The mid-cap IT is doing better, actually. And this is where I think the flows can continue. You will find good performance in the mid-cap IT also. And this is where we need to focus more. Beyond a point, large-cap ITs may not be able to perform. I think in the near term, yes, some more recovery is possible. But eventually, from a broader perspective, I need to look at the mid-cap IT more. Defense sector, I have got the query that how the defense space is looking at. So defense is a growing space. We have seen the order book positioning of all the prime players. Mostly the PSUs are there. 80% it is dominated by the PSUs. Some private players are also coming up. We have seen Bharat Forge, which is part of our portfolio, has seen a decent growth. Even some PSUs recently, as I discussed, Majgaon Dock is another category which has a 40,000 crore order book, and the market cap is also around 40,000 crore. So there is possibility of market cap expansion as if the order book positioning increases further. So defense, selectively we need to look at. We have taken BEML recently in our portfolio because we felt a long consolidation has already happened. And it looks relatively better because the order book positioning has just started increasing now faster. So that is all I think we have covered from the market perspective. We will keep on meeting in the coming months. And for any of your queries, you can always ask us in our webinar. So thank you very much. Thanks for listening patiently. And have a very good year 2024 from your investment and trading perspective both. Thank you very much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.